Okay, welcome to First Draft Live. It's Friday, September 26th. I'm Mark Bonner, editor-in-chief at BizNow, coming to you live from New York. Thank you to so many of you for joining the program today from the United States and overseas. We really appreciate it. For those who are new to the program this week, this is a show where we take the mess that is commercial real estate and wrestle it into something you can actually use. And quick reality check. This isn't the main event. The main event is our daily newsletter, The First Draft. That's where the real action is. Scoops before they hit the wires, charts before they hit the decks, and context before the spin doctors get their hands on it. This is not for tourists. This is for insiders. Written by me and a handful of the newsroom's most obsessive insomniacs, the kind of people who think a good time is parsing cap rate surveys at 6 o'clock in the morning. So for our First Draft live audience this week, consider this your backstage pass. 7 days on us. So sign up now. Simply go to biznow.com/firstdraft. That's biznow.com/firstdraft. Okay, today we've got a story that feels uncomfortably familiar. For years, people have warned of an AI bubble. Now the numbers are hard to ignore. Bain says the industry needs $2 trillion a year in revenue by 2030 to fund its compute build out, but it's only on track for about 1.2 trillion. Let me do some math here. That's an $800 billion shortfall. What are we going to do about it? Meanwhile, OpenAI, Oracle, SoftBank, they just rolled out plans for 5 more hyperscale campuses, pushing towards 7 gigawatts of new load. That's a lot. And NVIDIA's market cap has swollen bigger than the GDP of most G7 economies. And on the ground, Northern Virginia land values are up 60% year over year. Similar spikes can be seen in places like Dallas, Phoenix, even Columbus, Ohio. Billions of dollars are being poured into sites that either may be tomorrow's backbone or tomorrow's stranded stock. What does it all mean? Well, it could be that CRE is underwriting entire markets on demand that might not materialize fast enough. If the bubble bursts, it won't just be tech valuation at stake. It could be land leases, financing, and the very backbone of American reindustrialization. So the question is this the start of a new generational supercycle, or is this the setup for commercial real estate's next hangover? That's the question that's on the table today. And to help us sort the hype from the fundamentals, we've got Michael Pearce, Deputy Chief U.S. Economist at Oxford Economics. Michael, welcome to First Draft Live.
Thanks for having me. Pleasure to be here.
So let's just get into it. Is this AI bubble real? What do you make of it?
Yeah, I mean, the honest answer has to be maybe. I can't think of any major boom in investment that we've seen going back centuries where there's not been at least some speculative activity that ends up making a loss out of that. But for me, it comes down to is AI, the core question here is AI truly a revolutionary technology that's going to make us more productive? And my answer so far is this, yeah, this does seem to be the real deal. And everything that I can see from kind of the demand side and kind of how AI adoption is rippling through the economy suggests we're still in the very early stages of this boom. So if it is a bubble, I think there's still plenty of room left to run over the coming years.
There's been some really scary headlines over the last 6 months. I assume some of this is media hype, maybe not. I'd love for you to help me figure out and my audience what this really means. But this week in particular, we've got 2 things on deck here that I want to get into. First, let's start with Bain. AI companies will need $2 trillion in combined annual revenue to fund computing power by 2030, but the revenue is likely to fall $800 billion short. This is David Crawford, chairman of Bain's global technology practice, and I quote, if the current scaling laws hold, AI will increasingly strain supply chains globally. Then this morning, Greenlight Capital founder David Einhorn said the $1 trillion build out by companies overall, such as Apple, Meta, and OpenAI, is so extreme that the eventual returns are highly uncertain. And I'm going to quote him here. The numbers that are being thrown around are so extreme that it's really, really hard to understand them. I'm sure it's not zero, but there's a reasonable chance that a tremendous amount of capital destruction is going to come through the cycle. What's your response to this, Michael?
Yeah, I mean, they sound like sensible hedging statements. There's a lot of language there. This reasonable chance, not zero chance. Of course, there's always a chance of all this ending up being worth nothing. But I always come back to actually, this time around, what we're seeing is a lot of these companies generating very significant revenues. And that feels different from kind of the late stage bubble hype that kind of you might associate with, say, the dot-com bubble, where you had a lot of firms that were burning through cash, they had no revenues, they were taking on a lot of debt. I think what's striking so far about this boom that we've seen is how much of it is built on retained earnings, on private equity investments. There's not a whole lot of debt going into this boom, relatively speaking, and the revenues are there, right? So it's so far the money is the investments being backed up by real money, and that suggests to me that yeah, we may run into problems further down the line, but right now this looks like this has further to run.
Every boom looks permanent until it doesn't. We've seen this movie before, Michael. Japan's asset bubble in the 1980s, the dot-com bubble in the 90s, housing in the 2000s. Each of those moments in time for global economies had real innovation and lasting winners, right? Coming out of the dot-com bubble, Amazon, they survived. Many did not. What your specialty is macroeconomics. What can the Japan asset bubble of the 80s or the dot-com bubble of the 90s or the housing bubble in the 2000s tell us about the moment we're in right now?
Yes, I think first off, is you're right, kind of looking at where the actual value is and how sustainable this is. And clearly, you go back to those times, you saw this huge unsustainable run up in valuations. Valuations running way ahead of actual earnings. In the case of Japan, those land values running well above incomes. So what's the actual investment case here? I think the investment case is this is potentially transformative technology for the global economy. And so I always come back to, demand and supply. The demand for this AI technology is kind of this adoption and rollout across the broader economy. Now, listen, we did a big study on this a few years ago, kind of predicting out the net impact of AI on the economy. And, you have to make all sorts of assumptions kind of around adoption rates, how much it will do for productivity. We came up with these three kind of S curves for how demand for AI will roll out. And so far, what we're seeing is those actual adoption rates compared to what we were saying a few years ago are actually running, much closer to kind of the optimistic or the high scenario that we laid out rather than a median expectation. So, I think that's a sign that we're still on the early upswing of the kind of this S curve in adoption across the economy. And one other thing I will just point out on that, we have this great census data that asks firms, are you using AI to produce goods and services? But also, what's your expectation in 6 months from now? And we have this persistent optimism gap for the last few years. People are always saying, oh, yeah, in 6 months, we're going to be using a lot more AI than we are today. Well, that's actually caught up to reality now. The actual adoption is running now in line with where people thought it was going to be. So that we've had that huge catch up. So I think that's kind of the key driver of the demand of this. And from my perspective, doesn't look like it's going to end in the next 12, 18 months.
So look, I'm going to get into the real estate aspects of this in a few minutes, but let's just stay on the bubble for a second. All of these headlines that are being made in the finance world about these warnings, do you think it's cynical? Do you think it's in self-interest? Is the media making a mistake by going all in on this headline, knowing that it's going to click hard? Like, I guess what I'm trying to figure out here is for all of our viewers and our listeners, how do you separate the hype from the reality of the moment that we're in when it comes to that narrative that the bubble is going to burst and it's going to be scary and a lot of people, commercial real estate in particular, are going to be left holding the bag? How do you look at this?
Yeah, so for me, again, it comes down to looking at those fundamentals. So is the demand there? My view is yes, it is there. And then looking at the investment side, the supply side of where is all this money coming from? Is it being fueled by, there's a lot of indicators that would suggest this is highly speculative. If there were no revenues there, if a lot of it's financed by debt, And there will be some of that, and there will be losers, and that's why you always hear this kind of chorus of warnings, because they, eventually, can't think of any big boom where there hasn't been accompanied by some speculative activity that's gone wrong. But by and large, I think what marks out this boom is how much of it is backed by real money. This isn't We're not seeing a huge rise in business debt. So if we are going to eventually see some of these more speculative elements that kind of would be classic indicators of a kind of a late stage boom, we're not seeing them yet.
Okay, if, big if here, if there was going to be a bubble that burst, where would we feel it first? Now let's start macro and then let's dive into commercial real estate.
Well, I think the big thing, if you saw this puncturing of the optimism around AI right now, I think that because so much of it is being driven by these hyperscalers, and that's being backed by this tremendous run up in equity values. For me, the key vulnerability to the economy today comes through that equity market channel. And I think you'd see that directly, those firms reducing their spending, maybe growing their capex a lot more slowly, if we were to see a major stock price correction. But listen, I think the broader economy would be at risk here as well. One consistent theme I've heard from clients is the economy appears to be defying gravity. And I do think that AI story is a lot of that. Strip out AI related private investments actually declining so far this year. Strip out the big gains in the equity market, chances are the US consumer probably doesn't look so good either. So really, I think this huge rebound that we've seen in the financial market since kind of April, a lot of which has been driven by AI, not just feeding the actual investment itself, but supporting this broader consumption outlook, which is lifting all boats and making people more optimistic.
You're bringing up a good point. I mean, we're talking about $1 trillion build out across the country right now, right? You can't build it fast enough. There are headwinds on the ground everywhere, which we can get into in a second. But AI capex is largely carrying the US economy, papering over a lot of the pain that's below the surface. And the physical embodiment of that capex is physical spaces. And in this case, we're talking about data centers, right? Those are the structures and the equipment that need to be built to make AI happen for all that innovation. You take that away, and the U.S. economy looks pretty weak, or at least it's flatlining to some degree. Supply and demand, right? Tell me about where you're viewing that right now. The demand is stronger than garlic, but if supply cools, right, or if AI capex slows down, that does seem like it could be a potential house of cards. What do you make of that dynamic?
Yeah, I think that's where I see kind of all the risks to AI at the minute. It seems like there's still this huge latent pool of demand for AI services and products. But really, there's a lot of challenges that I see on the supply side that could trip this bubble up. Just on the physical side, power availability. And if it's not power availability, it's the knock-on impact on power prices, and not just then you're running into issues of, well, you're going to get local opposition. People are suffering pain because their household bills, utility bills are going up, and also they're building this big slab of concrete that doesn't create any jobs in your area. You could see a lot more local opposition to these constructions. So I think there's some physical risks on the supply side, but there's also probably a bunch of policy risks here as well. I think one that comes to mind is, given the tariff news we had overnight, on the pharma sector. Well, one big investigation that's outstanding is semiconductor tariffs. We don't know what's going to happen to that. That has the potential to create a lot of bottlenecks, and also push up the price of a lot of these investments as well.
And that's to say nothing of the other tariffs, right? Because, copper prices already super high with a 40% tariff going up even higher in the last 48 hours because of a disaster in Indonesia, which is the number 2 copper producer in the world. That is going to screw up pro formas on the construction side even more, right? So all of this coming together all at once, it makes for some trepidation if you're making these big decisions, Michael. I mean, what is the next shoe to drop, you think, Or what is the thing that you look at in the data that you fear could be the tipping point?
Yeah, I mean, where we have more insight is kind of on the policy side of things, and there, I think the clouds are gathering, and they're all inflationary and potentially limiting the supply side here. Whether it's the direct impact of tariffs, whether it's tighter immigration policy, which now seems to be focusing also on legal migration. That's going to raise the raise the challenges of finding skilled workers to come and help build out this infrastructure. We already see that. We already see that firms across the economy report that quality labor is one of the biggest bottlenecks, biggest constraints on expanding output. So those are kind of some of the factors that could really help weigh or slow down this expansion.
So let's go back to this Bain report that came out this week. Just to reset here, Bain estimates the AI ecosystem needs $2 trillion in annual revenue by 2030 to cover its build out, but it's tracking closer to 1.2 trillion. That's an $800 billion hole. For CRE, potentially, that's not abstract. It means hyperscalers may lease space today on assumptions that revenues don't deliver tomorrow. How serious is that $800 billion funding gap for real estate, Michael?
Well, I think in the near term, it's only going to grow, right? Because all the focus is on building out capacity first and worrying about the revenues later. Um, you know, if this, if we're right that this is a transformative technology, that we are seeing this adoption pick up across the economy, the demand is still going to be there, and we're going to see much stronger demand from a much wider base across the economy. And so I think the case is definitely there that the customers will certainly be there. The question is just the price, and the price is a balance between the demand and supply. So, but as everything that I'm seeing so far suggests that all the problems are on the all the limits are on the supply side. The demand right now at this stage feels limitless, but that won't be the case forever.
Does it cap valuations for data center assets?
Well, I'm just talking about the physical demand and supply of compute and therefore data centers and for these AI products. I think that adoption is running very hot, and I expect that to continue.
If you're just joining us, this is First Draft Live. We're unpacking the AI boom and whether it's really a bubble with Michael Pearce, Deputy Chief U.S. Economist at Oxford Economics. Okay, let's talk about the ecosystem in itself. NVIDIA sells chips into projects it helps fund. SoftBank seeds operators it also backs. Then Oracle leases space it helps develop. It looks like a virtuous loop, but CRE has seen how quickly that kind of reflexive structure can flip when revenues disappoint. We're fresh on our minds is CMBS in the year 2007. Michael, is this financing model sustainable or is it building fragility into the system?
I mean, I always go back to the fundamentals, and if we're right that the demand is going to be there, then I think all the other details mostly take care of themselves. And for me, when we're tracking this, it's difficult to get a scale of what we should be watching to track how useful this technology is to the economy. Right now, it's very easy to measure the dollars going in, the investment, the costs, right? The benefits, I think, where people are a lot less certain. And that has been true of every technology that we've seen going back centuries. And very often, the economic statistics are not the place to see that impact first. If we go back to the 2000 dot-com boom, what we saw there was the GDP statistics. These IT technologies were not adding to the economy. They weren't showing up in the data. And it was only when we changed or added better data collection that we saw that positive impact build later. I think the best for me leading indicator right now is what's going on with corporate profits, and we see very strong profitability, not just for these for firms involved in the build out, but for firms across the economy that are already beginning to start to apply this. So I think that's the place to track where this adoption might be building, and I think that's a positive sign for ultimately for future demand there as well.
So in this ecosystem, right, theoretically, if something falls apart and the economics don't work anymore, Who's left holding the bag? Banks, vendors, landlords?
Well, right now there doesn't seem to be much debt backing this. So I think mostly it's going to be the direct equity holders that have invested in these projects and are backing these names. But like I say, they're the big spillover is, well, a lot of people hold these names. It's hard to see some part of the AI ecosystem going down without seeing a major correction in the larger names. Things like Nvidia, Meta, they're just too big for the pain to be narrowly based. I think the whole economy would feel that slowdown and that reduction in optimism.
Okay, let me go to a question from the audience. I remember doing bank workout of server hotel projects during the tech wreck of 2001. Warehouses that had been converted to server use with large costs spent on raised floors, electrical and mechanical systems, etc. That ultimately had to be demoed out to restore the warehouse use. How will this boom be different for lenders, Michael?
Yeah, I mean, listen, that brings up a good point of stranded assets. If this build out does go too far, and listen, I think that's a very real risk eventually. But right now, I just don't see I don't see that in the near term. But clearly, there's a lot of factors here. The supply. For me, the biggest factor is if the supply pipeline is so strong that we get to a point. Right now demand is easily outpacing that supply, but we get to that point. The flattening of the kind of S curve of adoption across the economy, where that supply outruns the demand, and you see the price. You see that reflected in prices, and I think that would be the point at which I'd be very worried about kind of this fallout and the rise of stranded assets. But my big point is it still feels like that point is at least a few years away.
Okay. Let me go one more here. As AI infrastructure develops over the lifespan of new buildings, will its size requirements per building decrease in response to new technology and chips that have higher capacity and less space?
I'm not sure I've got much to add on that from a macro standpoint. Feels like everything's building towards greater scale.
I mean, some of these mega campuses are the size of Manhattan. I mean, at least that's theoretically they're going to be that size. It's unbelievable. Okay, Michael, I know you're a student of economic history, right? I mean, we kind of touched on a few different moments in time where there were bubbles that burst. If you're a commercial real estate player today, right, which that is the majority of our audience on the call today, and we'll be listening to on Spotify and Apple later, what lessons from past bubbles should commercial real estate players take most seriously right now? What's your greatest insight?
Yeah, I think it's when the problem with the bubble is everyone can feel that you're in it, and we're very clearly in the midst of this great transformation. But knowing, trying to identify that point of where you've gone beyond the fundamentals, there's more speculation than fundamental drivers there. For me, the things I come back to are is the demand, is the fundamental, is the technology fundamentally useful, and are we going to still see demand? Everything I see on that front is still looking healthy. And then I really worry about, well, what are the other players doing in this space? Are we building overcapacity? And listen, one thing I will point out is, that hyperscalers have been sharply raising their capex this year, but when you look at the forward projections, the growth rates actually taper off. So I kind of push back on the notion that we're kind of in this unconstrained capex boom. There is some moderation kind of in the forecast if you look at kind of the consensus what markets expect the Mag 7 to be spending. So if you were seeing those continually being ramped up, and the other big speculative element that you tend to see is when you get a lot of investment that's not backed by real money. So you see kind of measures of investment or capex relative to revenues, relative to income, really beginning to decline. And you can see if you look back to the early 2000s, you can see that peaked in 98. So kind of those last few years of the IT boom, you had this continuing investment in the space, even as the revenues began to start to disappoint. So that would be kind of the warning indicator to look at for this boom. And like I say, that's still rising. So there's nothing on the immediate radar. But it's challenging. It's a fast moving space, and there's there's going to be some losers. So we have to remain vigilant.
Well, like who could be a loser?
Well, I just saw this morning the friend.com measure the little pendant of a friend speaking. So there's clearly some, maybe that's evidence of speculation. Maybe I'm just getting old. That an AI companion or a friend that you carry around with you that's going to text you doesn't feel to me like a fantastic use of resources. So I think we will see lots of applications that end up falling well short of expectations.
I mean, part of the Bain report was, and the reason why for the $800 billion gap was because they don't believe that AI companies are charging enough for the product, right? And they're basically giving it away. And there's great tension there. Some of them are free and open to the public. Gemini comes to mind. OpenAI ChatGPT has a free model versus a premium model. The premium model, I believe, is around $9 a month. They insinuated that it should be 3x that if you want to close the gap, right? And there's great fear that on the consumer level that there isn't appetite to pay for it at that level because it hasn't revealed itself to be that useful, again, at the consumer level. Enterprise, a different matter. How do you square that?
Yeah, I mean, it feels like it's the same in every tech revolution, right? We get these new technologies that come in, they're free or mostly free at the point of service. And then once they built sufficient scale, that's when you get the monetization piece come in. And I feel like you can see that happening over the next few years. There's going to be a range of models. I don't think these companies are wedded to the free premium tier. Obviously that's how the consumer space is kind of played out for now. But there will be advertising. There will be I'm sure a range of models that the key is that other consumers and other firms getting the value that they see, and that's going to be the key to what they're willing to pay and what they're willing to bear.
I've got an audience member here who wants to go back to the dot-com era. Dot-com involved the build out of a brand new infrastructure, fiber, et cetera. AI is demanding expansion of existing public utility infrastructure, i.e., electricity, which is also a major headwind for data centers right now in the US. Does that make things different this time, Michael?
I mean, I think it means the challenges are a lot. I think the challenges on the supply side are greater this time, because a lot of these things require things that are controversial, right? Like new power lines, new power stations, potentially, big data centers near population centers. So these are all things that could generate a lot of public backlash and are difficult to deliver. We're already seeing that, this kind of backlog of interconnection requests. It's difficult to add that electricity capacity, and we've not done it. The last time we saw electricity production in this country rise sustained basis, kind of year over year, you've got to go back decades. So it's something we're going to have to learn to do very quickly. And that's why, for now, I see kind of all these risks on the supply side, that you're just not going to have the skilled labor base, the production in place to support all this supporting infrastructure to build it out. I think that's a lot more challenging.
Okay, Michael, my producer's starting to give me the hook here, but I do want to land on one question. Looking 5 years out, what do you think is the biggest risk here that you see for real estate?
I mean, for me, I think the biggest risk is that people put all their eggs in this one basket, and we see a collapse in the price. That the investment goes way down, and you're left with a bunch of stranded assets. If this AI thesis is real, I think the big lesson from history is that the effects of these large technological changes is to boost the economy overall. I mean, right now we're focused on all these negative headlines. Job losses. It's getting a lot harder for young people to find jobs, particularly recent college grads. And those are real stories. But you look back at every wave of technology, the result is an economy that's a lot more productive, that's a lot larger. And guess what? The people earning those, generating those revenues, go out and spend them, and that's good for. I think that's good for all asset types. Boost spending across the economy, boost productivity, and raises living standards. So that should be a kind of this broader boost for the entire portfolio rather than just narrowly focusing on this one sector.
Okay, we have to wrap up. Michael, thanks so much for being here, man.
Thanks. This was great fun.
If you missed any part of this episode or want to hear earlier shows, you'll find every conversation on your favorite podcast app. Just search First Draft Live. We'll be back next Friday with another deep dive into where capital, technology, and CRE collide. I'm Mark Bonner. This is First Draft Live. Have a great weekend, y'all.